Okay, welcome to Accounting 101. I believe this might be our fourth video. I'm not sure, losing track of them already. And we have 11 more chapters to go. Anyway, this video, we are going to be I'm going to be going over the solutions to the end of chapter assignments that can be found towards the end of the syllabus. And at the end of the chapter, there's several different color pages. The first part, I think, is a light green. You can, it doesn't show up. I'm using the ebook here. Everything's black and white, no color at all. And I think it's a light green thing where you can check your progress. And then at the end somewhere, they have the answers to those problems. You can do those. Those are optional to your on your part. Also, if you want to do other questions or short exercises or problems, and maybe when we do our Zooms, you can ask me about those or email me. But the minimum I want you to do are the ones that are under the section student assignments in the syllabus. Okay. So, I'm going to put it down as I see. And then I advise you to do them on your own and then watch this video and see how your answers compare with what my answers are. Okay. So the first chapter, we have questions 1, 3, 5, 7, and 12. And the first one is what is accounting? And okay. What is the definition found in towards the end, beginning of the chapter? It's an information system that collects and records, processes, and communicates information of a economic nature. Okay. The collecting and recording is what we've been doing with the journal entries that we did in chapters 1 and 2. The processing is the posting the journal entries to the general ledger and then preparing the trial balance. And the communication is taking the information from the trial balance and presenting it in the form of financial statements. Excuse me, my phone is going off. I'll be right back. Oh, come on. I'm sorry for the interruption. Okay, I think we answered review question number 1 about what accounting is. Number 3, describe the various types of individuals who use accounting information and how they use that information to make important decision makers. Well, the two main ones would be investors, owners, whether they want to buy a stock, sell a stock, or hold on to a stock, increase their investment in a certain company. Creditors, banks, bond investors, equity investors, and debt investors. Banks, any companies that may be dealing with the company and thinking of issuing the company credit so that they could buy inventory or supplies or raw materials. You don't lend credit to somebody who is not deserving of credit. One way you can see if they're deserving and make a decision is looking at their income statement, and looking at their net worth, the balance sheet. What are their assets? What are their debts? Let's say you're dealing with $1 million company and they have $900 million of liabilities and $100,000 worth of assets. Most banks would not lend money to a company like that because they are highly, highly leveraged. 90% of their assets are already pledged or have a claim against them, or could have a claim against them by the current creditors. You're going to get another creditor, become another creditor. Other parties would be the employee labor unions when they're negotiating a contract to see how much they should ask for or attempt to ask for. Regulatory bodies, Pennsylvania Utility Commission, when one electric company goes for a rate hike, or a water company goes for a rate hike, and a utility that's regulated. Stakeholders, if there's a company that is producing something and it's making a lot of noise or dust, the people that live around that facility may say, hey, you have to put noise abatement or dust abatement measures into effect, and you look at the balance sheet. Can they afford to do that? Yes, they're making a lot of money with whatever industry they're in your neighborhood, and for one reason or another, they're doing something that upsets the neighbors. The neighbors can look at the financial statement and say, hey, they can afford to put some abatement controls in there. So the list goes on and on and on. I'm trying to think who else off the top of my head. I can't think of any more than that, but I'm sure there are some suppliers, vendors. Just somebody, you're thinking of buying a tractor. Take a look at the company's financials to see, how long the company's been around, how stable they are. Because you buy a tractor, you're thinking, it's not like a car, 3, 4, 5, 6 years. You buy a tractor, you're thinking long term, 15, 20, 25 years, 30 years. Are they going to be around? Are they sustainable? Are they going to be around? Are you going to be able to get parts and service on that tractor you just bought from it? Okay, a lot of information can be gleaned from the financial statements. Review question 5. What is the role of the Financial Accounting Standards Board? And then in parentheses, they have the acronym that it's known by FASB, FASB. That is the authoritative body that makes the rules for accounting in the United States of America. Not North America, just the USA. It's headquartered up in Connecticut, Norwalk, Connecticut. I believe there's 12 or 15 members. Most are CPAs, not all. They like to have some non-CPAs on there. They'll have a representative from government, one from academia, or at least one from industry. And they have a whole bunch of different committees, which is the Emerging Issues Task Force, that looks at new trends in business. And, there are things out there now that weren't contemplated 25, 50, 100, 75 years ago when the original rules were made up. So accounting is constantly changing. Give you a case in point is when I was a student, everything was based on historic cost. Now we are moving more and more towards using fair market value because it is more relevant. May not be, historic cost was revered because it was reliable. You could always determine it. Fair market value fluctuates from time to time, but it is more relevant. And we'll get into that later on in the semester when, especially chapter, we'll talk about it a little bit when we're talking about inventories in chapters 5 and 6, but definitely when we're talking about investments in chapter 10. Review question 5. We just did that one. I'm sorry. 7. Describe the similarities and differences among the 4 different types of. I got to scroll down here. Business format entities, I guess. Business entities discussed in the chapter. There's a exhibit in the chapter that does a very good job of that. I forget. I think it's 1-4. But basically, the 4 types of business entities you can have would be a proprietorship, which is one owner, unincorporated. A partnership, 2 or more unincorporated owners. A corporation, 1 or many, thousands or tens of thousands, if not hundreds of thousands of owners. And a LLC, limited liability company. The first 2, the proprietorship and the partnership, they're separate entities from an accounting standpoint, but from a legal standpoint, they are not separate from the owners. So any liability incurred by the proprietorship or the partnership, any owner, proprietor, or any of the partners can be held joint or several liable. What joint and several liability is you can go after one or all of the owners in satisfaction of a debt or a claim, or in event of a lawsuit. They file informational returns with the IRS, and the informational return will show how much each owner gets of the income generated by that business entity, and then the individual reports that on their personal 1040 tax return. There is no limited liability. Any partner or the proprietor, obviously, can bind the business entity in a contractual situation. In a corporation, you have limited liability. The most you can be sued for as an owner, the most money you have at risk is the money you have invested in the corporation. If it goes bankrupt, you lose it all. But they cannot come after your personal assets in satisfaction of any corporate debt. The corporation, because it offers this nice protection of limited liability, also has the downside is that it, as its own legal person, must file its own tax return and pay taxes in its own name. Then any subsequent distribution to the owners in the form of dividends is taxed again at the shareholder level. So you have double taxation. Oftentimes in big multinational corporations, or even big regional or national ones, ownership and management are separate. In a smaller corporation, family corporation, ownership and management are usually the same set of people. Let's see. The partnership and proprietorship can be formed relatively easy. With the partnership agreement, proprietorship, you don't even need an agreement because there's only one owner. So the formation is relatively easy and inexpensive. A corporation, you must file paperwork with the Department of State in whichever state or commonwealth you're incorporating in, and comply with it. And, it sounds like something that involves a lawyer. Yeah. And that lawyers cost money. The registering fees cost money. None of that has to be done with a proprietorship or a partnership. It should be done with the partnership. You should get the partnership agreement should be drawn up and looked at by a business attorney, but you can agree to do anything you want as long as it's legal. Corporations are somewhat limited in what they can do. The corporate charter is issued by the state. And another big difference is the proprietorship and partnerships begin and end with the partner or the proprietor. Corporations have an indefinite life. They can, you have a change of ownership in a proprietorship or a partnership is difficult. You have to sell it, and it becomes a different entity with the different owners. A corporation, you have the ease of transferability among owners by selling the share of stock. It doesn't affect the corporate operations or the corporate status in any way, shape, or form, or taxability. I think that about LLCs. LLCs are a hybrid. They have to have at least one general partner who's liable, and then the limited partners have limited liability. It's a hybrid of a corporation and a partnership. Again, the partnerships have the drawback once you get over maybe 25, 30, 40 people. It gets a little bit difficult to have that many owners, that many chiefs. Board of directors in the corporation, each of the shareholders gets one vote for each share of stock they own, common stock they own, and they vote for the board of directors. The board of directors hire management and give them guidance, and then let management run the day-to-day affairs. So it allows you to have a lot more owners, and sort of like a government, you elect the board of directors, and they look out for your interests as an owner, and you don't have to be too much involved except to sign your dividend checks and deposit them every quarter if it pays dividends. Okay, I think we exhausted that one pretty good. Let me scroll down here. The next one is review question 12. Explain the role of the International Accounting Standards Board, IASB, in relation to the International Financial Reporting Standards, IFRS. Well, earlier we had the one about FASB. FASB, the rules, regulations, standards they issue are called GAAP, Generally Accepted Accounting Principles. The IASB is a organization that sets the accounting rules that corporations and accountants must follow for, I'm going to say, the rest of the world. Every country except the United States of America. There's, I believe, 192 or 3 countries in the world, depending on how you count. I forget, Singapore or Vatican City or one of those ones, whether it's a sovereign nation or not. Presently, last I saw a few years ago was 160 some countries have adopted IFRS. And I would imagine that's now somewhere up in the 170 range. So they wanted to merge and get together, FASB and IASB, and they got very, very close, but they couldn't agree on about 3 or 4 major stumbling blocks. So they decided to put it on hiatus for a while. I think it will eventually happen because of the global nature of the economy and corporations getting active. More and more multinational corporations, even the ones that are multinational, are expanding to more and more countries. And it's going to ease the transfer of capital and the allocation of capital. It's going to make it more efficient through the various economies in the world. Again, IASB is a standard setting boards for IFRS, the International Financial Reporting Standards. And they are a lot vaguer than the FASB's GAAP. FASB's GAPs are rules, and the IFRS that are coming from IASB are more general and vague in nature and give some discrepancy to the professional financial managers and accountants. Provide some guidance, more or less say, do the right thing, handle this way, that way, and do it in a way that best describes the transaction, where we have rules. You're going to use this, you're going to use that. You can't do this, you can't do that for GAAP. Okay, short exercises 8, 9, 12, 13, and 14. I've got to change my page here electronically, which should be easy to do. Oh, there it did. Short exercises, so I got to get over to sometimes I can use the arrows to scroll down. Sometimes I have to bring the cursor over. Let's see, what do we have here? 8. Identifying accounts. Okay, they give us a list of account names, and they want us to identify it as an asset, liability, or an equity. Well, those three classifications are the balance sheet accounts. I'm going to expand on it, and I'm going to say the equity, anyone that's an equity, we should also define whether it's a pure equity account or if it's a revenue, expense, or dividend type of account. So accounts payable, we have the magic word payable there. That is definitely a liability. Item B, cash. Cash is an asset. C, common stock is definitely an equity type account. D, accounts receivable, magic word receivable, and whenever you see that, it is guaranteed that that is an asset. Rent expense, well, as it implies there, it is an expense, and that would be a indirect reduction of equity. Service revenue would be the opposite. It would be a indirect increase in equity. And office supplies would be an asset. Dividends would be a contra equity account or a reduction of distributions to owners, equity being the claims of owners. Land is an asset. Salaries expense is definitely an expense account, as identified as such, self-identified, but it would be indirectly a decrease to equity is what they're driving at there. Not real keen on how they said identify them, as they should have used all 6 different types of accounts there. All right. Oh, come on. It just jumped on me to, I don't know what page. I went back to the problems here. You touch the thing and it jumps. It doesn't move, and then you hit it again and it jumps 10 pages. Bear with me here. Check your understanding, review. Now, I went from page 44 to page 27. Yeah, this is great. Now I'm up to page 52 from page 28. Come on. Now I'm in chapter 2. Exercises. Okay, sure. What are we? Okay. Back in chapter 1. That's good. I'll try to turn the page here. And go to the exercises. They want short exercise 9. How do we do that? Okay. Use the scroll. Short exercise 9. Use the accounting equation to analyze the transactions. Tiny Town Kennel earns service revenue by caring for the pets of customers. Tiny Town Kennel is organized as a corporation. During the past month, Tiny Town Kennel has the following transactions. They give you A, B, C, D, E, and F. And they say indicate the effects of the business transactions on the accounting equation for Tiny Town Kennel transactions. A is answered as a guide. All right, so let me get some paper here and a pen and a clipboard. And basically, they're want us to do what I advised us not to do in chapter 1, because nobody does it this way. Instead, I wanted to waste the time, and we went right to doing the journal entries. So I just have the accounting equation on my paper there, and we'll go down these transactions. I'll put A in the margin. We received $520 cash for service revenue earned. So the asset cash is going to be increased by $250. I'll put a plus sign underneath after it. I guess I should put it before it. I put an arrow. And revenue under equities, it's going to be plus by a revenue of $520. That's how it would affect the accounting equation. Underneath, I'm going to write the journal entry for it, how it's done in the real world. Okay. B, paid $325 cash for salaries expense. So the asset cash would be decreased by $325 when we give the employee their paychecks, and the equity account is going to be reduced because we had a cash outflow. Assets went down, so owners, the company got smaller. So now the owner has less, so the equity is smaller with an expense. The journal entry there would be salaries expense. And a credit to the asset called cash, $325. Here's what they want you to do. Hey, cash went down, equity went down. Assets got smaller, the company got smaller, liabilities didn't change. This does the same thing. You incurred an expense, the company got smaller because cash went out in the form of a paycheck to employees. C, received a $1,000 contribution in exchange for common stock. Okay, let's assume that it's $1,000 cash. So cash would be increased by $1,000. The company is now bigger than what it was, and common stock would be increased. Plus $1,000 common stock. That's what it would look like in the accounting equation format. The entry, it's a lot nice and neater, and the way it's really done. D, earned service revenue, $604, but the customer has not paid Tiny Town Kennel yet. So the asset accounts receivable would be increased by $640, and retained earnings equity would be increased $640. Oh, revenue. Equity, yeah, revenue. Okay. D, in the journal format, we would see accounts receivable, service revenue. $640. E, we received a utility bill, which will be paid next month. So you have an expense. So equity would be reduced by the expense, $85. And the liability would be increased, $85. So you see, all A, B, C, and D affected something on either side. Oops, my elbow touched my mouse. Affected things on different side of the equal sign. Over here, both things that are affected are on the same side of the equal sign. One goes up, one goes down. Here, cash went up, equity went up. Cash went down, equity went down. So depending where they are relative to that equal sign, they move in the same direction. If they're on opposite sides, something increasing, something else increasing, but something of a different nature, different type of account. Cash goes up, equity goes up. An expense goes up, a liability goes up if it's not paid. Okay. If it's on the same side of the equation, Somebody that had a receivable, we paid us, cash goes up, the receivable goes down. They're both on this side of the equation, equal sign. On this one here, we had a bill come in, so it reduces equity by $85, and it increases the liability because it's going to be paid next month. We didn't pay it right away. F. Cash dividends of $100 were paid to stockholders. So the asset cash is reduced $100 and equity is reduced $100. Dividends. $100 payment. The company is smaller. Equity drops because the owners, instead of putting money in, they're taking money out of the company. All right, not my favorite exercise there. Oh, wrong computer. I'm using a mouse on one and a touchscreen on the other, so you bear with me here. Next one we have to do is 12. And they say use the information, following information to answer short exercises 112 through 114. Centerpiece Arrangements has just completed operations for the year ended December 31, 2024. This is the third year of operations for the company, and the following data have been assembled for the business. And they just give you a bunch of accounts there, okay? What I'm going to do, if you're looking at your textbook, I'm going to take that information they have there that's all over the place. I'm going to try and arrange it in a more workable format. Actually, what I'm going to do is I'm going to prepare a trial balance. You know, they just spilled out a whole bunch of things there for us. So I'm going to set this up and I'm going to go through it and I'm going to show you how I'm going to do it. Centerpiece arrangements. Trial balance. And it's for the year ended December 21 or December 31. 2024. Okay, so we have a debit column. And we have a credit column. So I'm going to make a trial balance. So I put a heading on it. Name of the company, trial balance for the date that's pertinent. Set up my two columns for debit and credit balances. And I'm just going to go down here. I'm going to, in the margin, write how the accounts appear in the chart of accounts and how they appear in the general ledger. So we would have assets, liabilities, equities, and revenues and expenses. I wrote them vertically. I should have put them this way. So the assets are going to be up here, then the liabilities here, the equity accounts here, the revenues here, and the expenses down here. And I know from experience, I wouldn't expect you guys at this point in time, but sometimes, yes. Well, I'll walk you through here. The first one they say is insurance expense. Well, that's an expense, so it's going to go down the bottom. So I'm going to write it down by where I'm going to group the expense accounts. And I know that expenses have a normal debit balance, so I'm going to put that $4,500 in the debit column, like so. And I'm going to say service revenue. Well, that revenues are underneath equities but above expenses, so I'm going to write in service revenue. And I know revenue accounts have a normal credit balance. I don't see a parenthesis around it or a negative sign in front of it, so I know it's a normal balance. It's $70,000. So I'm going to put $70,000 in on the credit side for revenues, service revenue. Utilities expense, under the expenses. $1,400 would be a debit balance. Rent expense, again, another expense account. Rather nice, giving us some close to each other, one after the other. $16,000 on the debit side. Just put it in right down here, rent expense. Common stock is an equity account. Regular, no negative on it, so it's a normal credit balance. So I'll put $9,000 in the credit column. You can see I moved up to where I had the equity grouping. All right, and there it is over on the credit side. Cash is an asset, so I'll go up the top and write in cash by the assets. $7,200. Normal balance is a debit, so I'll put it in the debit column. Retained earnings, but look, it says retained earnings January 1, 2024. So that's the beginning of the year. Retained earnings is an equity account. So I'll put it right under common stock. But I'm going to notate here that it's January 1, 2024, which is the beginning of year retained earnings. Equity account written right under common stock. I then put the amount in. It's a credit, $5,100. So there we have it now, right here on that line. Now I go up to the next column. I have some more expenses, salaries expense. So I'll group that with the expense accounts. $46,000. And accounts payable is a liability. Well, show you the salaries expenses down here. Liabilities, accounts payable. So I'm going to put it in with the liabilities. And that is $17,006. Normal balance of a liability is a credit. Office supplies, $1,700. Those are assets, so I'll put them under the cash. Office supplies, cash, $1,700. Debit balance. Dividends is under equity. It's a contra equity, so I'm going to write it right under the common retained earnings. Dividends. So the normal balance of dividends is a debit, $4,800 in the debit column. Dividends, debit column. Accounts receivable, an asset up the top with the other assets. Normal debit balance. It's not in brackets or a minus in front of it, so we can assume that it's a debit balance, safely assume. There it is right there, accounts receivable, $8,000 debit balance. And finally, equipment, we know that equipment is an asset. Normal debit balance, $12,100. Okay, so now I have everything that they gave me, I've listed, but I've got it in order by classification, by type, assets, liability, equity, revenues, and expenses. So now I've got essentially I have a trial balance here. It's not the prettiest trial balance because I had left spaces, didn't give it a lot of planning, but it'll work. Just ignore the spaces. Turn my light on here to activate my solar powered or light powered calculator, and I'm going to add up the columns. Oh, let's see what we get here. 7,200 plus 1,700 plus 8,000 plus 12,100 plus 4,800 plus 4,500 plus 1,400 plus 16,000 plus 46,000. 1,700. Now, I drew a line to help me separate the debits and credits, added all the debits up, and I got 101,700 down the bottom there. Now I'm going to do the same with the credit column. 17,600 plus 9,000 plus 5,100 plus 70,000. Wow, am I 101,700. So they balance down here. So now this is a starting point to answer what they want us to do. Prepare an income statement for centerpiece arrangements. I will use this information. I could go through everything they gave me, but I'd have to, there's a better chance of making a mistake there because it's not arranged properly. So now, income statement. I'd have a heading up the top, centerpiece arrangements, income statement, for the year ended, December 31, 2024. So there's the heading. Now, an income statement, I'm going to just throw up a skeleton and then fill it in. What's an income statement? It's just a combination and summary of all the revenues and all the expense accounts. So let's see what we have. We have the trial balance. We have the revenues here. There's only one. And then we have 1, 2, 3, 4 expenses. So I'll get that information right from the trial balance. The service revenue was $70,000. The expenses, I have insurance expense, $4,500. Should have showed you after I put in the revenues up the top. Now I'm going to list all the expenses. I already have the insurance expense there. Utilities, $1,400. Rent, $16,000. And salaries, $46,000. Draw a line, and then there, slightly down, I'm going to say total expenses. I'm going to add up the, which there was only one. All right. 500 plus 1,400 plus 16,000 plus 46,000. 67,900. Since I'm subtracting the expenses, I'm going to put it in brackets. I'm going to subtract that, the total of the expenses, from the total revenues. Change sign, add 70,000. $2,100. It's a positive number, so we're going to call it net income. The revenues are greater than expenses. If it was more expenses than revenue, it would be a negative number, and we would call it net loss. Okay. The next deck, that was exercise. Oh, come on. 1-12. 1-13 wants us to prepare the statement of retained earnings. I'll do that right underneath. Save some centerpiece arrangements. Statement of retained earnings. And again, it'll be for the year ended December 31, 2024. Just the heading I have there. Now, our starting, what the statement of retained earnings does is it shows the beginning of year retained earnings and the changes made to it throughout the year to arrive at the retained earnings at the end of the year. So let's write down retained earnings. And the beginning of the year would be January 1, 2024. And we look at the trial balance, and that is given as $5,100. Retained earnings, beginning of the year, January 1, 2024, $5,100. And that was information they provided us. Now, to that, we are going to add net income. That's not in that trial balance. But we use the information in the trial balance, the revenue and the expenses, to determine what net income was. So that net income of $2,100 is going to come down here. Gives us a total or a subtotal of $7,200. $5,100 plus $2,100 is $7,200. Then we say less dividends. We can get that right from the trial balance, was $4,800. We're going to, since it's less dividends, we're going to put the dividends in brackets. Don't have to. I mean, people can read. And then you subtract those two numbers. Just let's see. So 200 minus 4,800. We get a balance of $2,400. And we will call that what it is, retained earnings at the end of the year. Retained earnings beginning of the year, increased by net income, subtotal, take out the dividends, get retained earnings at the end of the year. Notice here we got retained earnings, and here we have retained earnings, but this is January 1, beginning of the year. This is December 31, end of the year. Now, again, we had to do the income statement because we needed the net income or net loss to do the statement of retained earnings. We need the statement of retained earnings, end of year balance to do the balance sheet, which I believe, yeah, exercise 15, doing the balance sheet. So once again, I'm going to put a heading, centerpiece arrangements. Balance sheet. And there's a little bit of a difference in this heading. It's going to say December 31, 2024, instead of for the year ended, because Income statement, statement of retained earnings are for a period of time, as is the statement of cash flows. The balance sheet is for one point in time, one date. I'm going to set up the format here. Assets. Now 1, 2, 3, 4. So I'm going to need 5 lines. 1, 2, 3, 4, 5, and then the liabilities. And how many liabilities do I have? Just one. Total liabilities. Okay. And here's the basic shell of a balance sheet. Assets up the top, followed by the liabilities, followed by the stockholders' equity. And we'll just go through back to the trial balance, list all the assets, total them, list all the liabilities. I think there's only one in this case. List it, list the equity accounts, total them, combine the liabilities and the stockholders' equity, and that should equal the total assets. Balance sheet. Okay, so going back to our ugly but still accurate balance sheet, because it balanced, debits and credits were equal. And all the balance sheet does is prove that the debits and credits equal. Doesn't guarantee that we didn't make a mistake, because if you reversed accounts but you did the debits and credits offset, you're still going to balance. So under the assets, we have cash, office supplies, accounts receivable, and equipment. And then I'm going to list their balances: 7,200, 1,700, 8,000, and 12,100. Listed the name of the account and its balance right from the trial balance or from the information they gave you, but it'd be more difficult. That's why I took time to do the trial balance, because it has everything arranged in neat order. And then I'm going to total those. And I'm going to call it what it is: total assets. $29,000. That doesn't sound right. We'll find out. I'll check myself here. Oh, 29,000. Added in 20s. Liabilities, I only have one, the accounts payable. Um, 17,600. And then I'm going to say total liabilities. Well, probably should double underline that. So I put a double underline. That means stop. Have liabilities. They only had one. Accounts payable. 17,600. Total liabilities. 17,600. Now I'm going to get the equities. It's going to be the common stock and the retained earnings. But the retained earnings from the statement of retained earnings. So I get the end of year that matches with my date on the balance sheet, not the beginning of the year. So common stock. I could find that balance right on that trial balance. There is $9,000. And retained earnings at the end of the year is, what do I do with that paper? $2,400. So I list the common stock and the retained earnings as of the end of the year from the statement of retained earnings. Combine those two things and I get $11,400, and that is called total stockholders' equity. Common stock and retained earnings together, total stockholders' equity. Now I'm going to add the liabilities and the stockholders' equity together, and hopefully it's going to equal the assets. And I'm going to call it what it is. Total liabilities and stockholders' equity. I don't have to use a calculator, but I will anyway, since it's here. $29,000. So the last thing I did was combine the liability, total liabilities with total stockholders' equity to get the $29,000. The total of the liabilities and the stockholders' equity of $29,000 agrees with the total assets of $29,000. So the balance sheet has to balance. The total of the liabilities and stockholder equity and the total assets must be equal. If not, made a mistake somewhere along the line. So let's see. Exercises 20 and 26. Probably have to turn the page here, and hopefully it goes from page 36 to page 33. Exercises. Let's see which one we have to do. 20. Come on. Again, arrows don't work, so I have to use scroll bar. Scroll down. Exercise 20. Using the accounting equation. They give us three scenarios there for, let me get it down on paper. They show, compute the missing amount in the accounting equation for each entity from the financial information provided. And they give us three companies. And they also give us the assets, liabilities, and the equity. And for hairstyles, they don't know what the assets are. They tell us the liabilities are $36,000 and the equity is $36,000. So the question mark must be, let me put this up here. There, I just listed, they only listed the columns and the name of the company. I made the equation. Assets equal those two added together. So this must be 72,000. You can see it in red there. 72,000. Again, red's not the best color for accounting. Some people may interpret that as a negative. Style cuts. We have 90,000 in assets. We don't know the liabilities, and they tell us the equity is 48,000. So what's the missing number? This is algebra. Okay. 42,000, right? Plug in, search for the missing number. Oh, college. This is third grade arithmetic, I think. At least it was when I was in third grade. And then finally, the company called Your Basket. We have 101,000 in assets, 68,000 in liabilities, and they don't know what the equity is. So 68 to 100 would be 32, and another one would be 33,000. Now, exercise 26. Now the hours are working, so I'll get down there a little bit quickly and more accurately. Using the accounting equation to analyze business transactions. And then again, this is that big monstrosity of the thing. Let's see. Indicate the effects of the following business transactions on the accounting equations of Vivian's online video store. Use the following accounts: cash, accounts receivable, office supplies, office furniture, accounts payable, common stock, dividends, rental revenue, and rent expense. Transaction A is answered as a guide. Received cash of $10,000 from the issuance of common stock. So the company is getting $10,000, an asset, cash, that's going to be a debit to cash, an increase in cash, and it's going to issue common stock to the investor that gave him the $10,000. So it's going to increase common stock with a credit of $10,000. B, earn video rental revenue on account, $2,800. Be careful here, on account. We're not getting the cash, so we get the next best thing to cash. An asset called accounts payable is being increased by $2,800, and a revenue account called rental revenue. Rental revenue is being increased. That would be a credit of $2,800. C, purchased office furniture on account, $300. So now we're getting an asset, office furniture. So office furniture is going to increase with a debit. And on account, accounts payable is a liability account is going to be increased $300. Item D, received cash on account, $400. So the asset cash is going to be increased by $400 with a debit. The asset accounts receivable is going to be decreased with a credit of $400. E, paid cash on account. So that we had a liability, probably from maybe item C. So we're owed them $300. We're going to pay them $100. So the liability, accounts payable, is going to be decreased with a debit. We're paying them with a check, with cash. So the asset cash is going to be decreased with a credit of $100. F, rented videos and received cash of $200. So the asset cash is being increased with a debit of $200, and rental revenue, a revenue account, is being increased by $200. G, paid monthly office rent of $1,000. So the rent expense account is being increased by $1,000 via a debit, and the asset cash is being decreased with a credit of $1,000. And then H, paid $100 cash to purchase office supplies. So the asset office supplies is increasing, debit, and the asset cash is decreasing with a credit, both for $100. That's 26. Okay, so that's it for chapter 1. Let me try and get to chapter 2 here. Finally, the thing just doesn't respond. Okay, come on. Let's see if I can get the end of chapter. Okay, review questions. Here we go. All right, what I've got here in the syllabus is review questions 2, 3, 6, 7, 10, and 11. Okay. 2. What is the purpose of the chart of accounts? Explain the numbering typically associated with the accounts. The purpose of the chart of accounts, it's like a legend on a map. It describes how the accounts appear in order by type. Okay, so you'll have the assets listed first, followed by the liability accounts, followed by the equity accounts, followed by the revenue accounts, followed by the expense accounts. The numbering system we discussed in the previous lecture. Regardless of how complicated the system is, the asset accounts will always have the account number or account code will always start with the digit 1. That designates an asset. It can also be a alphabet number in there. Like I think I used the example, if we had a store in Pennsylvania, a store in New Jersey, cash would be account number 111. See, the 1 designates it's an asset. The 111 designates a specific asset, in this case, cash. And then we could say, hey, our Pennsylvania store, call it 111 PA. And the New Jersey store would be account code 111 NJ. And then if we had 2 stores in PA and 2 in New Jersey, we could follow 111 PA1 for the first store, 111 PA2 for our second Pennsylvania store, and the same with the New Jersey store, NJ1, NJ2. All right. Explain the numbering system again. The liabilities accounts would start with the digit 2, and then you could use subsequent digits or alphabetic characters to designate whatever you want to try and place it or describe it, whether it's long-term, short-term, which is chapter 4. Don't worry about that right now. 3 would designate the equity accounts, common stock, dividends, which is a contra equity, and retained earnings. There's another one we'll see in chapter 13, but don't worry about that until chapter 13. Revenue accounts would begin with the digit 4. So far, we've only seen one revenue account called service revenue, and we saw in the last exercise we did in chapter 1 rental revenue, the video store. Let's think of a auto dealership. They could have any number of revenue accounts. They could have a revenue account for new car sales. They could have one for used car sales. They could have one for parts sales. They could have service department revenue. Okay. If you have a restaurant, you can track revenues from food, revenues from beverage sales. Okay. The revenue would be a 4, so your food account could be 410, and your beverages could be 420. Or you could have 421 for soft drinks, 422 for adult beverages, beer, wine, or you can even have 422 for beer, 423 for wine, 423 for liquors. Or, you can even go further and further. If you want to divide it down by the brand of beer or the type of wine or the brand of liquor. You could do the same thing with your food. How many steaks, revenues for, let's say 401 is steak, 402 is chicken, 403 is fish. And you could even break it down further, type of fish, whether it's lobster or flounder or halibut. Keep just going out with the number. Or you could put a letter in there, 411L for lobster, 411S for steak, 411PK for pork, or PC for pork chop. It's endless. But regardless, if it's a revenue account, the first digit is going to be a 4. And same thing with an expense account. First digit's going to be a 5. If you have a manufacturing plant, payroll is significant. You'd have account 511 for payroll, salaries and wages. Okay. If you had a plant in PA, 511 PA. If you had one in Jersey, 511 NJ. You could tell which one is which. If you work in 3 shifts, you could go 511 PA1, 511 PA2, 511 PA3. You could have also, if each of those, OT for overtime for those shifts. Now, for financial accounting purposes, it wouldn't matter. On the income statement, we'd lump it all in on one line item called salaries and wages. But for management, if they were able to break it down like that, they could check on how much you're running overtime. Hey, maybe we should hire an employee or two and say we could save money, depending if the overtime is out of control or not. We can also look at how much payroll, how much labor is being generated manufacturing a given level of product, and how come New Jersey is producing the same amount with less labor, or vice versa, producing less with more labor, and management knows there's a problem there. The value and beauty of accounting information. Chapter 2, review question 3. What does a ledger show? What's the difference between a ledger and a chart of accounts? Well, the ledger shows the individual accounts and all the activity within those accounts, the debits and credits, which would be increases or decreases depending on the type of account it is, and the balance of that account. Okay? A ledger is a collection of accounts with the general journal transactions posted to those accounts. The chart of accounts is merely a listing of the accounts that are in the general ledger. It doesn't have any balances. They aren't individual accounts. They're just the name of the accounts, and they show you the order in which they appear and their account code. 6, when our debits increases, when our debits decreases, and 7, when our credits increases, when our credits decreases. So we'll do these two concurrently. If you have your little 3x5 note card handy, that will answer this question. It depends on the normal balance of the account. So let me reproduce that thing right here quickly. So it's expenses, dividends, liabilities, revenues, and equities. Those are the normal balances. So debits would be increases when you're dealing with an asset, expense, or dividend account. When are debits decreases? When you're dealing with a liability, revenue, when are debits or equity account. When our credits increases, when we're dealing with a liability, revenue, or equity account. When our credits decreases, when we're dealing with an asset, expense, or dividend account. Uh, 6 and 7. Okay, that takes us up to number 10. Where are transactions initially recorded? In the book of original entry, the general. Okay. 11. Explain the 5 steps in journalizing and posting transactions. Well, first thing you do is analyze which accounts are being affected. Okay, identify the accounts. Identify what type of accounts those specific accounts are. One of the 6 that we just alluded to with the normal balances. Determine the normal balance. Determine if that account is being increased or decreased. Then, based on what type of account it is, figure out whether it needs to be debited or credited to increase or decrease it, and then by how much. Okay, that's how we do the journal entries. And posting, all you do in posting is take the information from the journal entries sequentially and take it and put it into the ledger account, the specific ledger account. If it's a debit in the journal entry, it's going to be a debit in the ledger, in the account. If it's a credit in the journal entry, it's going to be a credit when we post it to the T account in the general ledger. Let's see, 10, 11. Oh, that's it. Okay, short exercises 1, 2, 3, and 5. Yeah, I got to turn page, and hopefully I go in order here. Short exercises. I think it worked. Short exercise 1, identifying accounts. Again, repetition here, just to give us practice on identifying what type of account it is. Again, they want us to identify it as an asset, liability, or equity account. I think we should go further and identify if it's an equity account. Is it a true equity account, or is it a revenue or an expense account? It would be an indirect increase or decrease to equity. A, note receivable. We see the word receivable, right away we know that that's an asset, guaranteed. B, common stock is an equity account. Prepaid insurance, another tip-off word. Prepaid indicates prepaid followed by a word that sounds like it may be an expense, but it's prepaid. We haven't used it up yet. It's an asset. Note payable, item D. The word payable indicates that it's a liability. Whenever you have a word followed by the word payable, guaranteed that your last bottom dollar that it's a liability account. Excuse me. Rent revenue, ideally it's a revenue account, but it would be, in this case, according to what they want, it would be an equity account because revenues increase equity. Taxes payable, we have the tip-off word there, payable, liability account. G, rent expense, obviously it's an expense account, would be an indirect decrease of equity. Furniture is an asset. Dividends is a contra equity account or dividend account. And finally, unearned revenue. When you see the word unearned in front of some type of revenue account, guaranteed, it's a liability account. Why? Because somebody has paid us before we have delivered the goods or services. So we took their cash, but we haven't delivered our goods or services. We are obligated to give them the goods or services, so we're liable to give them the goods or services. If we don't provide the goods or services, we'll have to return the money they paid us. All right. Short exercise 1, 2. Come on. For each account, identify whether the changes would be recorded as a debit or a credit. So this is just a way of identifying the normal balances. Again, you could refer to your little 3x5 note card or the table I advised you to make. An increase, basically how you solve this one is you have to identify what type of account it is. Okay, and then you can look at your little T account. A, an increase to accounts receivable. Well, accounts receivable is a asset. Assets have a normal debit balance, so you would debit accounts receivable to increase it. A decrease to unearned revenue. Unearned revenue is a liability account. The normal balance, what you need to do to increase it would be a credit. So to decrease it, you do the opposite, and you would debit unearned revenue. That will happen in Chapter 3 when we take it from the liability account and put it into the earn. Once we deliver the goods or services, then we can record it as a revenue. But when we do that, we've satisfied our obligation and we've delivered the goods or services. So we will decrease the liability unearned revenue and increase a revenue account. Decrease to cash. Cash is an asset. Normal balance is a debit. So that would increase it. It would be decreased. Therefore, it would be decreased with a credit. D, an increase to interest expense. Interest expense, normal expense accounts have a normal debit balance. This is an increase. So you would debit interest expense to increase it. An increase to salaries payable. Salaries payable is a liability. Increase with a credit balance, since credits are the normal balance for liability accounts. A decrease to prepaid rent. Prepaid rent is an asset. Therefore, to decrease it, we would credit the asset called prepaid rent. G, an increase to common stock. Equity account, normal balance is a credit, so we would credit common stock to increase common stock. An increase to notes receivable. Note receivable, the word receivable designates that it's an asset. Normal balance would increase it. The normal balance of an asset is a debit. A decrease to accounts payable. Accounts payable is a liability. To decrease a liability, you would debit a liability, since its normal balance is a credit. An increase to interest revenue. Interest revenue, being a revenue account, would have a normal credit balance, so to increase it, you would credit interest revenue. That's number 2. Number 3, identifying normal balances, much of the same. Note payable, liability, normal balance would be a credit. Dividends, normal balance is a debit. Item C, service revenue, would be a credit. Land is an asset, so the normal balance would be a debit. Unearned revenue is a liability account, therefore the normal balance is a credit. Common stock is an equity account, normal balance a credit. Utilities expense is an expense account, so the normal balance would be a debit. Office supplies is an asset, normal balance would be a debit. Advertising expense, an expense account, normal balance would be a debit. Interest payable, liability account, normal balance would be a credit. 1, 3, 5. Okay. It's not on there, but let's throw it in here anyway because it's a quickie. They show us an accounts payable there in a T account with 2 debits and 4 credits. Calculate the balance of that account. Well, what do? We'd add up the debits. What do we got there? 17,500, and add up the credits. We got 9,000, 30,500. So 30,500 less 17,500, have a $14,500 credit balance. All you do is add up the total of the debits, total of the credits, and take the difference and put the difference on the side that has the larger amount. Short exercise. 5. Journalizing transactions. Okay, this is good. This will give us practice. Let me get my journal paper out here. Okay. John Daniel opened a medical practice in Sacramento, California. I wonder if his friends call him Jack Daniels. Yeah. And had the following transactions during the month of January. So January 1. The business received $34,000 cash and issued common stock to Daniel. So the asset cash gets increased with the debit of $34,000. And common stock gets increased with a credit of $34,000. January 2nd. Purchase medical supplies on account, $17,000. Let's see what's going on here. Let's stop and think a minute. We're getting medical supplies. Medical supplies would be an asset, so we're going to debit an account called medical supplies. For $17,000. We're not paying for them at the present time, but we've got them on account. So we promised to pay the company we're buying them from. So we're going to credit, we're incurring the liability. We're giving them our promise. Accounts payable is going to be increased with a credit of $17,000. It says to include an explanation. Yeah, the entry itself is explanatory. Or, they're giving us the explanation here, and we're just taking that and putting it in form of a journal entry. January 4th, we performed services for patients receiving $1,600. We're receiving $1,600. To me, that sounds like we're getting cash. Cash gets increased with the debit, $1,600. And we provided service, so let's call it service revenue, call it medical fees, let's call it service revenue since that's what we've been seeing so far in the book. Service revenue. And then on the 12th of January, paid the monthly office rent of $3,000. So we have an expense called rent or office rent. Either one is acceptable. Rent expense. And we paid it. What do you think the landlord wanted? They wanted a cash. So we give them a check for $3,000. And our expense gets a credit of $3,000, and our asset cash gets a credit of $3,000. And on the 15th of January, we recorded $7,000 revenue for services rendered to patients on accounts. Okay, so I guess we're billing the insurance companies. So accounts receivable is going to be debited for $7,000. And service revenue is going to be increased with a credit of $7,000. Okay, now I think we can move into the exercises. Those are the short exercises. Exercises 12, 16, and 17. Let's see what that looked like. Well, got to turn the page, cross my fingers, and hope it goes to the next page. Yes, it did. Thank the Lord. Exercises 12. Oh, come on. Identifying accounts, increases in accounts and normal balances. Again, we've done this, but at this point in the game, the more we repeat it, the more we do it, the better we'll get at it. And it says identify each as an asset, liability, or equity account, and whether it gets increased to debit or credit, identify whether normal balance is a debit or credit. Well, that's the same thing. Redundancy. Well, I should be critical. We're being redundant with these. All right, 212. Exercise 212. Interest revenue. It's a revenue account, but according to them, we're going to say it's a equity account. It's an indirect increase to equity. Normal balance would be a credit. It would be increased with the credit. Accounts payable, liability. Normal balance would be a credit, would be increased with a credit. Common stock equity account, normal balance is a credit. It would be increased with a credit. I'm doing it back. They want whether it's debit or credit, increasing then the normal balance. Office supplies, asset, would be increased with the debit. Normal balance is a debit. Advertising expense, It would be, as an expense account, normal balance would be a debit. They want us to say whether it's an equity. It's a reduction of indirect reduction of equity, so it would be a debit, because equity having a normal credit balance, to reduce it, you would debit. Unearned revenue liability account, it would be increased with a credit. Normal balance is a credit. G, prepaid rent, that's an asset. No, it would be increased with the debit. Normal balance would be a debit. Utilities expense, normal balance of an expense account is a debit. They want us to say whether it's liability, asset, or equity. It's an indirect reduction of equity. Equity has a normal credit balance, so therefore to reduce it, you would debit. Utilities expense. Dividends is a debit to increase it, contra equity account. And J, service revenue, would be, in their case, a indirect increase in equity account, so be increased with a credit, and its normal balance would be a credit. And what do we have here? 16. Next. Okay. Hey, it's moving with the arrow. Analyzing and journalizing transactions. Journalized transactions for Lawrence Engineering include an explanation with each. Now we don't need to do that. Use the following accounts: cash, accounts receivable, office supplies, equipment on, accounts payable, note payable, common stock, dividends, service revenue, and utilities expense. Do I have any more journal paper here? Yes, one sheet. Oh no, we got a couple here. Okay. We're going to run to the copier and make some. Okay. And then they want us to post the T accounts. So bring some T accounts over with me. And I'm going to write these down as they give them to me. Lawrence Engineering. They give them in order. Yes, they do. So cash. Let me get a better pen. It'll show up better. Okay, what do we got here? Cash. Accounts receivable. I'm just going to abbreviate A/R. Office supplies, OFC supplies. Equipment. Accounts payable. So that's all the assets. Now we have a liability with accounts payable, and another one with notes payable. A/P, N/P. Abbreviation, common stock. Dividends. Service revenue. And utilities expense. So all I did was get one of my handy dandy T account sheets and write down all the accounts they gave me, and God bless them, they put them in order. Okay, I'll put that up there for now, and then compute the balance for each account. Okay, they want us to post the journal entries. Let's see, open the following accounts. Post the journal entries to 2 accounts, also the dates to 2 accounts. What am I missing here? Oh, okay. I didn't see the information is up the top here. Use the following information to answer exercises 216 and 217. Okay, so in that little box, they give us the transactions for July for Lawrence Engineering. So July, Up the top, July 2nd, he received a $14,000 contribution from Brett Lawrence in exchange for common stock. So it looks like he's investing in the company. So the company is getting cash, gets increased with the debit, and in exchange, they're issuing him common stock for $14,000 each. Okay. On July 4th, he paid the utility expense of $370. Now, I don't know about you, but if I'm Brett Lawrence on the 4th of July, I'm a good American. I'm having hot dogs and beer, hamburgers and beer. I'm not paying a utility expense. I guess he must not be a real good American. So we have an expense here called utilities. It gets increased with a debit. How do we pay it? It says paid, past tense. So it's cash going out, not on account, $370. July 5th, purchase equipment on account. So that's an asset. We're picking up equipment. It's getting increased with the debit. And I don't know, let's see. The equipment on account would probably be accounts payable. $1,600. $10, perform services for client on account, $2,900. So we're not getting paid. So we're going to pick it up and put it in an asset account called accounts receivable. We're taking the customer promise to pay us at some future point in time, but we did do the work, so we can put it into service revenue. We can recognize it because we have performed, and that was for $2,900. Asset account receivable gets a debit. Service revenue gets a credit. Both those accounts are being increased because of the account involved. July 12th, borrowed $7,100 cash, signing a note payable. So we borrowed money from someone, and we signed a piece of paper saying that we'd pay him back and what time, what date, how long, any interest. So we're getting cash. It's an asset, so it gets increased with a debit, $7,100. We're incurring a liability, so notes payable gets increased with a credit of $7,100. July 19th, cash dividend, $200 paid to stockholders. So dividends gets increased with the debit. We paid in cash, so cash gets reduced with a credit, $200. On the 21st, purchase office supplies for $804 and paid cash. So the asset office supplies gets increased with a debit of $840, and the asset cash gets reduced with a credit of $840. July 27th, they say we pay the liability from July 5th. Looking up to July 5th, we got the equipment, and we're paying it off. So the liability gets paid off, gets extinguished, gets satisfied. Accounts payable will be reduced with a debit, and cash will be reduced with a credit, and the amount there was $1,600. Okay, so we have journalized the transactions they described, and we set up the T accounts. Let's see, we open up the T accounts, which we did, posted journal entries, and okay, so 17 is we have to post these journal entries to these accounts. It says we're not going to give them any posting reference numbers here. They didn't give them to us. We could do it if we wanted to, but let's take the first one. And cash on July 2nd. Cash gets a $14,000 debit. Debit in the journal. It's a debit in the ledger. Common stock gets the offsetting credit. Cash gets the debit. Common stock gets the credit. July 4th. No, I put utilities up there. I should put utilities expense. Okay, I just noticed I didn't put the word expense there. Utilities expense. Maybe you caught me and you're yelling at the YouTube video. So now the utilities expense is going to be debited for $370, and we're going to designate that July 4th. And cash is going to be decreased with a credit on July 4th. So the utilities expense gets increased, the cash gets decreased July 4th. Equipment is purchased on the 5th of July, $1,600. It's a debit in the journal, it's a debit in the ledger. We got it by incurring a liability. So accounts payable will be increased with a credit. Right there. And on the 10th, we get accounts. We do work for somebody, but they don't pay us, but they give us a promise to pay. So it's going to be a debit to the asset accounts receivable, $2,900. Right there. And service revenue that's credited on July 10th for $2,900. We get cash by signing the note payable on July 12th. $7,100 debit to cash. $7,100 credit to a note payable. There's the $7,100 to cash. There's the $7,100 credit to the liability note payable. I'm sorry. Okay. Trying to look through the paper here. Okay. Next one is we pay dividends. So dividends on July 19th gets increased with a debit, $200, and cash gets decreased with a credit of $200 on the 19th. There's the debit to dividends and the credit to cash, both on the 19th. On the 21st are increased $840, and cash is decreased $840 on the 21st. One asset goes up, office supplies, another asset, cash goes down. We exchanged cash for office supplies, one asset for another. And finally, on the 27th, we paid off the liability. So cash gets, accounts payable gets a debited for accounts payable, $1,600 debit to reduce it on the 27th, and cash gets reduced as we had to pay the liability on the 27th. So accounts payable gets reduced $1,600 on the 27th because we paid them cash on the 27th. Now it says the last thing we want to do is determine the balance of these accounts. Okay. I'm going to do the ones with one entries first. Oh. They're all of them only have one debit or credit except cash account. So let's see if we get the answer they told us. I don't know what that cash balance 1890 is. I don't think that's us, but let's see here. 14,000 plus 7,100 would be 21,100, and that didn't take it. Yeah, 21,100. And then on the other side, we have 370 plus 200 plus 840 plus 1,600. Total of 3,010. Yeah, okay, I got the same thing they got. $18,090. $18,090. You total the debits, you get 21,100. You total the credits, you get 3,010. Take the difference between the 21,100 and the 3,010, and you get $18,090. Compute the balance for each account. Well, that's the balance of cash, and all the other ones are just the one number that's in that account. No addition, no subtraction required. So 16. So that's it. All right, we're running a little long here because I have to do all my writing, but I rather do them in real time so you can see it instead of me just throwing up a paper that's already been completed and then you don't see how it's done. All right, again, a little long, but don't forget we did 2 chapters. All right, I'll be seeing you in the future, probably with a review. I have to, let's see. Oh, I have to check it if we have an exam coming up after chapters 1 and 2, or did we hold off to 3? I'll have to check the syllabus and get back to you.